To our webinar, Join the Issues, Insurance Coverage and COVID-19. We promise you this will be the best webinar on these important insurance coverage issues. 3 reasons why. Number 1, we have outstanding lawyers from both sides of the aisle on this webinar, representatives both of the policyholder side and the insurance carrier side. Number 2, this webinar is free. There's no charge for this webinar. We hope you enjoy it. And reason number 3, we're doing this as part of a charitable fundraising activity, part of the Will Work for Food project, raising money for food banks all across the country and all across the world. So far, the Will Work for Food project has raised over $22,700 for food banks all over the world. And again, while there is no charge for this webinar, if you like what you see and you like what you hear, we hope that you will consider contributing to a food bank. I'm going to introduce each of our panelists and ask them to tell us, in alphabetical order, about a particular food bank in their area. Let's start with Jan Larson of the law firm of Jenner & Block LLP. Jan, please.
Great, thank you, Jeff, and thank you for having me. I am based in the Washington, D.C. office, and I would like to put in a promotion for the So Others Might Eat food bank in Washington, D.C. Their acronym is SOME, and they can be reached at www.some.org.
Great, thank you. Jerry Oshinsky of the law firm of Kasowitz, Benson, and Torres LLP, please.
Good afternoon, everybody, and thank you, Jeff, for having us. This is a great pleasure. My food bank is, I live in Santa Barbara, California, and my food bank is the Food Bank of Santa Barbara, which you can easily find online.
Wonderful, thank you. Leena Soni of the law firm of Nicolaides, Fink, Thorpe, Michaelides, Sullivan, LLP, please.
Hi, everyone. The food bank that I would like to promote today is called the Northern Illinois Food Bank, and it can be reached at solvehungertoday.org.
Wonderful, thank you. And Julie Weerth of the law firm of Wood, Smith, Henning Berman LLP, please.
Hi, good afternoon, and thanks, Jeff. I'm speaking today on behalf of Long Island Cares Food Bank. It was established, I'm speaking from Long Island, New York. It was a first food bank on Long Island, established in 1980 by singer, songwriter, and activist Harry Chapin.
Wonderful. A wonderful group of causes. Let's get right into it. We are talking about first-party claims for business interruption as a result of the coronavirus, business interruption losses as a result of the coronavirus. So first, let's talk about what are the coverage grants. Jerry Oshinsky, would you please take 2 or 3 minutes and lay out the basics?
Sure, Jeff, thank you. Well, you hit on the first one, business interruption. These are first-party property policies that cover risk of loss to your business because of, well, today we're dealing with the coronavirus as the cornerstone of this presentation. These are all risk policies, meaning that they cover all risk of loss of or to your property unless there's an exclusion or a limitation in the coverage. These are the flip side of comprehensive general liability insurance. So there's presumptively coverage if you have a business loss or a business interruption, unless the insurance company can show that there's an exclusion or a limitation that prevents the coverage from applying. In addition to the basic coverage grants of business interruption, business income loss, extra expense, there are often extensions of coverage to categories that we'll get into later, in particular, civil authority orders which prohibit or preclude you from utilizing your business in the manner intended, or dependent property coverage, which means property that you are dependent upon to supply you, for example, with components of products that you're making or customers that you're serving. Because of, in particular, orders of civil authority, it may very well be that the property that you depend upon to supply you or to buy from you is not available. And that type of dependent property coverage is typically covered by first-party all-risk property policies. On the flip side, we also have to be aware of the exclusions from coverage, which we'll talk about later as well, where, again, the burden is on the insurance company to establish whether or not there's an exclusion that might apply to preclude coverage that would otherwise be available in the policy. So that's the basics. Business interruption, business income, extra expense, order of civil authority, dependent properties. Those are the
Okay,
basics.
the table is set. Let's start the banquet. The first topic is perhaps the most important, the requirement of direct physical loss of or damage to property. And to start the ball rolling on that, let me call on Julie, please, to tell us about a little of the history, how we got here, and what are the big issues today. Julie, please.
Thanks, Jeff. Well, physical loss or damage is a requirement contained in most property policies. This is a requirement easily met if the property sustains damage from fire, wind, or water, but gets a little more difficult to establish in the event that the property or structure is unaltered to the naked eye. Adding more ambiguity is that the courts from state to state have not uniformly interpreted what this term means. To understand the controversy, it may be informative to start at the beginning of where physical loss or damage as a requirement actually incepted. In fact, it's a requirement that is of a relatively recent vintage. The first property policies in the 1700s were for fire. This evolved in the 1800s to all risk policies in which perils other than fire could be added by endorsement, and these policies form the basis of the modern property policy. In the 20s and 30s, physical loss or damage made its way into language via marine all-risk policies. It is not particularly understood how precisely physical loss or damage was identified and included at that time, but it's speculated that this was to avoid payment for claims for diminution in market value caused by delivery delay, loss of value, or lost profits. It's important to know that, as used in the insurance clause, the word physical modifies both loss and damage. The terms loss and damage are not necessarily synonymous. Physical damage is not only one cause of physical loss of property. For example, an insured can suffer a physical loss of property through theft without any actual physical damage to the property at all. The courts who have weighed the meaning have basically come to a conclusion about whether certain categories of risks qualify as physical damage. One example is pure financial loss, which is generally understood not to constitute physical damage. Our more current issue is most analogous to the situation of loss of use caused by bacteria or potentially noxious gases. These are damages that are not visible to the naked eye, but could cause a business interruption. Two of the cases that basically speak to a case in which there's no real physical damage are the Roundabout Theater in New York, which was closed due to a structural damage to a neighboring building. In that case, the court held that there was no physical damage, so unfortunately the business interruption of the theater, which was ordered to close by municipal requirements, did not trigger the policy. As well, another case, Newman Myers versus Great Northern Insurance, involved business interruption that was caused by a lack of power to the premises of a law firm, an insurance coverage law firm at that, in New York following Hurricane Sandy. The court held there, again, that there was no physical damage to property. In New Jersey, by contrast, a factory that had to close because of noxious ammonia in the air made it perilous to human inhabitants, and therefore the court held that, in fact, there was physical damage to property. I will now turn it over to Jan to discuss some other holdings with respect to bacteria or noxious gases, or the policyholder view of physical damage.
Thank you. Jan, please.
Great. Thank you, Julie and Jeff. So picking up on the theme that Julie mentioned as to policies that include both the terms physical loss of or damage to, I think where we are seeing policyholders go with these arguments in the lawsuits that have been filed to date, which are relatively numerous at this point, is in one of two directions. You have one group of policyholders, in particular those that do not have virus exclusions that we are going to talk about shortly. Those policyholders tend to argue that the presence of the virus on their insured premises is what creates a physical damage to those premises. So that is one group of policyholders, and they are really keying off of the use of the term damage in that context. Then you have another group of policyholders that are really keying off of the other term, loss, and in particular loss of, and they are arguing in many instances that it is not necessarily the virus, but in fact the government shutdown orders that are creating a physical loss by rendering the insured premises non-functional for its intended use or by impairing its intended function. So it's really a loss of use argument for that camp of policyholders. And that is true both during the period in which the government shutdown orders are in place, but I think we're also going to see that argument extended once those orders are lifted, to the extent that insured premises need to be physically reconfigured to be in compliance with new reopening restrictions. So for example, if you think about restaurant seating or event space needing to be reconfigured in order to dramatically reduce the number of occupants in those spaces, I think that is where the physical loss of use argument will turn as things start to reopen. And as Julie mentioned, a central part of the argument is really where the policy uses both the terms loss and damage. What policyholders are seizing on is that those terms should not be interpreted as redundant of one another because they both appear in the policy, and they must instead have some separate meanings ascribed to them. So in other words, covered loss of the property and covered damage to the property can be separate concepts here. So there are a couple of other cases that I will mention in the context of the loss of use arguments that may find their way into this discussion over time. So first, there's a Colorado Supreme Court case called Western Fire that held that there was direct physical loss when gasoline fumes entered church premises and then rendered those premises uninhabitable and unusable. And then similarly, there's a case from the Minnesota Appeals Court that again found a direct physical loss where oats of a company called General Mills, the cereal manufacturer, were rendered unfit for sale, even though they were not necessarily unsafe to consume because there had been an unauthorized pesticide entered into the air. So there, interestingly, the court said that the function of the products was not only to be sold, but to be sold with an assurance that they met certain regulatory standards. And they really focused on the fact that that function had been impaired, and that is what constituted the loss of use of the product there.
Okay, let's take a few minutes and open it up to general conversation. Let's go back to the insurance carrier side. Leena, I'd love for you to comment first, and then Jerry, please.
Sure, I just, both Jan and Julie's comments indicate that a careful review of the policy wording is required on both sides to advance arguments. And because of the novel nature of the pandemic, and we're going to have to look to other types of claims and losses to provide guidance for us.
Gary, please.
Yeah, something that Jan said spurred a new thought, and that is reconfiguring the buildings is really mitigation of damages, trying to reduce damage that would otherwise occur or injury that would otherwise occur. It seems to me that costs or expenses incurred to do that would fall under mitigation provisions in these insurance policies. And in old historical English terms, those would be called sue and labor clauses. It was a concept that meant if you went out to mitigate your losses, you'd be covered by the insurance policy, whether or not you had an underlying covered loss or not. So I think that's another area that we could focus on as another potential for insurance coverage that I did not mention in my opening remarks.
Julie, you've heard these other three experts speak. What thoughts does it prompt in your mind coming back?
Well, it'll be interesting. I think while the cases on record speak to various categories and components of what has been litigated before, we should be cognizant that this is an unprecedented event for which result-oriented decision-making may result. So whether or not a court has found physical loss or damage for a noxious gas versus a power shutoff is going to be analogized to one way or the other to trigger coverage for coronavirus or not. I can say that recently the Southern District has issued an order to show cause with respect to coronavirus, applying the Newman-Fitch holding and stating basically that there is no physical damage, and so that they were following the law. I suspect that the Southern District, that this will be appealed and perhaps the question will be certified. However, it seems like that one court is applying the law as established.
Mm-hmm. To the policyholders, thoughts, comments?
I'm glad that Julie mentioned that decision, because there are two opinions. There's one in New York, which came out in favor of the insurance companies, and there was a decision in Paris this week that came out in favor of policyholders, which held that there was coverage for, we'll get into this later, orders of civil authority without underlying causation. So you now have two opinions, one in a transcript in New York, one in a French opinion, which go in opposite directions. And this is going to go the way of pollution and the way of asbestos. There are going to be decisions coming down, hither and yon on every which issue, going in every which direction. And we're going to find opinions that we'll all be able to debate about on both sides of the ledger.
Will there be a lot of forum shopping, state versus state, federal versus state?
That's if I may comment, yes. We will find policyholders and insurance companies trying to go where they think will be more favorable to their point of view, both from the standpoint of choice of law and other related characteristics. But the thing about this, Jeff, that's really interesting, these are standard form policies. So why should the law be any different as to how these standard form boilerplate policies are construed? And I think it's really important to get into the drafting history that Julie mentioned to see what the insurance industry intended when they wrote these policy forms. That'll be helpful to our side.
Leena, you're nodding. Your thoughts, please.
I echo what Julie's saying, that I think, and Jerry, we're going to have decisions across the board, and it's going to be in the vein of the countless property decisions we have on every issue, where policyholders and insurers counsel will be able to analogize to particular facts. Not all factual situations will be helpful under the current circumstances, because we have questions about what the virus is and how long it exists, and what, if at all, it causes any damage to property, and if it does, how quickly that damage can be resolved.
Julie, you began the discussion. We'll give you the last word and the opportunity to take a minute or so and sum up and allow us to move forward, please.
Well, I think understanding what the intent of the industry is in issuing these policies and the history of them is important, because what will be quite evident is that the policies were meant to cover physical loss of damage in the classic sense, which is observable physical damage. Back in the origination of these policies, which were originally fire and then graduated to wind and hail, etc., the circumstances of the of a bacteria or a virus were not contemplated. It's only after years of evolution and some adverse development in the courts that the language has been construed beyond the original intent.
And that's where we find ourselves moving forward in the debate. Let's move on to our next topic, which is the civil authority grant of coverage. And Jerry, if you would please take a minute or two to put the ball in play, and
Yeah.
Leena will ask for you to comment first from the insurance carrier side. Jerry,
Well,
please.
The civil authority coverage, as I mentioned earlier, is an extension under the policies. And keep in mind, these are all risk policies. So they're not going to say we cover virus or we cover an automobile accident. They cover all risk of loss of property or to property. And the word of is very important, that Jan mentioned earlier today. So you get into the civil authority. What is civil authority coverage? Civil authority coverage is actually specifically entitled in most policies, civil or military authority coverage, which prohibits access to property by an order of civil authority that says that certain property cannot be accessed because of an underlying cause. And sometimes the underlying cause can be the civil authority order itself, which prevents you from accessing your business, and as a consequence, you lose income or incur extra expense. A classic example historically is in the time of the World Trade Center attack. A quick geography lesson: the World Trade Center was on the west side, lower west side of New York City. The lower east side was closed down by an order of civil authority by the mayor, who closed the entire southern part of New York City. I had clients who were on the east side, did not incur property damage, but the question was whether or not, because their business was closed down by this order of civil authority, whether they had coverage under their policies or not. And that wound up in litigation, which actually got settled. So unfortunately, there was no resolution. But our argument was that the order of civil authority that closed down all of the southern part of New York City because of the attack on the World Trade Center gave rise to coverage for my clients who were located on the east side of the city. We have the same thing here today. We have, in California, where I live, we have a statewide order that basically is a stay-at-home order. So because of that order of civil authority, I'm sitting in my home office today. There are a lot of businesses that can't function the way we can. We're very fortunate that we do this, professors for pay is what I call ourselves sometimes. And we're very fortunate that we can actually have this wonderful conversation with these great lawyers. Most people are not that fortunate, and they're out of business because of these orders. And as a consequence, I believe that if they have all risk policies, they are covered. I think that the order of civil authority provides two functions. Number one, it's the covered cause of loss, and it's also the proximate cause of the damage that many people are incurring today. So that's a quick and dirty discussion of it. But it's really perhaps the most important part of the policies these days. And one last comment. There was a decision in France that came out this week where an order of civil authority basically closed down the entire city. But in particular, 4 restaurants sued their insurance company, and they got a decision in their favor that said that the order of civil authority in Paris gave rise to coverage, whether or not there was any underlying cause. In my jargon, the order of civil authority was both a cause and a consequence of their loss.
Leena, how does it look from your side of the aisle?
Well, I agree with Jerry. These stay-at-home orders that basically have been ordered from all municipalities, states to stay at home, obviously is a civil authority order, but the impact that it has on a particular insured is dependent on the policy language, the impact for coverage is dependent on the policy language. And 2 unique key elements of the civil authority coverage grant is that the property damage must occur to property that is other than the insured's own property. So an example is when a municipality cordons off certain property that's been damaged by fire or tornado or potential collapse, because they want to either protect the property from further damage or protect people from being injured from that property. And if the insured's business has then become inaccessible, civil authority coverage may apply. In the situations we have now, these governmental shutdown orders, first of all, are not in the context of other property. Policyholders currently filing claims allege simply that the order has stopped their business and has resulted in the suspension of their operations. While this is true, courts have required a nexus between the physical loss and damage to the other property and governmental order. So an example in the coronavirus context is a suit filed by attorney Mark Garagos, where he alleges that he's entitled to civil authority coverage because the city and state stay-at-home orders have prevented him from running his law offices. Interestingly, he has admitted that the practice of law is an essential business that's exempt from the orders, but nonetheless, his practice has slowed down. He's unable to meet with clients, etc. As we can see from this webinar right now, lawyers are able to work outside of their offices. So how that turns out for Mr. Garagos will be interesting. In that case, the insurer has filed a a separate action, saying that there is no civil authority coverage because the policy wasn't intended for the current situation we have. The 9/11 authority that's out there is analogous and likely will provide support potentially for both sides. From the insurer's perspective, there is a case called United Airlines versus the state insurance company, or let me see, the insurance company of the state of Pennsylvania. In that case, United Airlines alleged that it was entitled to civil authority coverage as a result of the ground stop order issued by the Federal Aviation Association, or FAA, after the attacks on the World Trade Center and the plane that resulted in the crash in Pennsylvania. The United Airlines alleged that it wasn't able to conduct its airline businesses because of the governmental order and because alleged adjacent property, namely the Pentagon, was damaged. Both the trial court and the Second Circuit disagreed with United Airlines and ruled that there was no coverage because A, the Pentagon was not adjacent property, and B, even if it was adjacent property, the order was issued before damage to the property. So it was, I guess, somewhat of a precautionary order or a fear that there would be further terrorism attacks. Here, that leads to the important question of why these orders have been implemented. And while some of them reference property damage, the ultimate reason for these orders are to prevent the spread of COVID-19 and not for the protection of property. So in the coronavirus context, it's difficult to see how the civil authority coverage could apply given the grant and its requirements, as well as analogous 9/11 cases that would prevent such coverage.
Okay, Jan, any thoughts you have from the policyholder side?
Sure, I'll just offer this brief thought, picking up on something that Leena said. To the extent that civil authority coverage is really geared towards, the physical loss of or damage to property occurring to that is other than the policyholder's property. Query whether the policyholder even needs to resort to the civil authority coverage at all in the coronavirus context. If we take the policyholder's argument that I mentioned previously, that it is the order itself and not necessarily the virus that is preventing them from being able to use their property for its intended purpose and therefore resulting in a loss of use of that property, perhaps the policyholder does not even need to resort to the civil authority coverage. And there may be some advantage to that to the extent that a particular policy might limit the civil authority coverage either with a lower dollar value sublimit, with particular radius restrictions in terms of where it is that the damage must occur to other premises. Sometimes it's 1 mile, sometimes it's as far as 100 miles, and other policies can also have limited civil authority coverage in terms of the number of days that it applies, providing for only a 30-day recovery period or, for example, a 60-day recovery period.
Julie, final thoughts from the insurance carrier side, please?
Well, I think it is noteworthy that the civil authority is not a panacea in the event that physical damage or loss cannot be established for the reasons set forth by Jan. Many of the forms contain sublimits or other limitations about geographic scope, or limitations as to what components of loss they will reimburse. So suffice it to say, it isn't a guarantee of the whole available limit to the extent it can be established.
Okay, thank you. Well, we've talked about some of the basic coverage grants, and in every insurance policy, there are also exclusions. And so let's turn our attention to those. Let's talk about the virus exclusion, other exclusions, and potentially the issue of concurrent causation. Leena, if you could please put the ball in play on that subject, and then Jerry, we'll hear from you first on the policyholder side. Leena, please.
Okay, thanks. A lot of claims filed to date, or I should say lawsuits filed to date, allege that because the policy does not have a particular exclusion that addresses the virus, coverage is available. The problem with that is that it ignores that argument, or those allegations ignore the fact that it's the insured's burden to prove the coverage grant in the first place. And if they're unable to do that, any exclusion becomes irrelevant. Having said that, in 2006, the Insurance Services Office proposed and developed a specific virus exclusion that now has been written into many policies, or a version of it has been used in policies. It specifically says that we will not pay for loss or damage caused by or resulting from any virus, bacterium, or other microorganism that includes or is capable of inducing physical distress, illness, or disease. Obviously, on a plain language analysis, the coronavirus falls within that exclusion and bars coverage under a commercial property policy. The comments that were submitted by the ISO when proposing that exclusion specifically indicated that while the pollution exclusion may bar coverage for certain viruses, the concept of unorthodox transmission of infectious material needed to be addressed specifically. The comments reference anthrax, Legionnaire's disease, and other types of potential pandemics or viruses that could result. So the history of the virus exclusion is important, specifically because there are no reported cases that address that ISO version of the virus exclusion that likely insurers will rely upon if it's included in their policies. If it's not included in their policies, there are other exclusions that may apply, including the pollution exclusion. Historically, the pollution exclusion applies to environmental damage and seepage of environmental. However, policies do define pollution sometimes to include contaminants. While pollutants haven't been defined to include viruses, some courts at least have recognized viruses as a contaminant and therefore applicable, therefore having the pollution exclusion be applicable. So depending on the jurisdiction and the case law out there with respect to the pollution exclusion, it too could be a viable defense. Lastly, with respect to exclusions, both counsel for policyholders and insurers need to look at whether the states recognize or the jurisdiction recognizes concurrent causation or efficient proximate cause. With concurrent causation, if there's a covered peril and a non-covered peril, coverage will be allowed. With efficient proximate cause, the court will look at what was the dominant cause of the loss. If it's an excluded cause of loss, there will be no coverage.
Jerry from the, thank you, Leena. And Jerry from the policyholder side?
I think from the policyholder's perspective, you have to go back to basic principles before you talk about the details, and that is, what was the reasonable expectation of the policyholder? Would a reasonable, non-legal policyholder, these policies have to be read by, as if they're read by lay people, not by attorneys, would a lay person understand efficient proximate cause, concurrent cause, and ensuing loss? These are concepts that lawyers have trouble with. I don't think that a smart policyholder would understand these distinctions. But let's assume that these are in play. One of the things that I have seen in policies that is a counterpoint to concurrent causation is ensuing loss. You often see policies that say, we exclude XYZ unless there's ensuing loss that's not excluded. And almost anything that you can think of can fall into the category of ensuing loss if you have that covered. One other point that occurred to me really for the first time listening to it today, the business about whether a code of authority or military authority has a distance restriction on it. You have to be within a certain scope of adjacent to the area that's affected by the code. How do you deal with that when you have an order that affects the entire state? It wipes out to me, it wipes out the obligation that you have to be next to or adjacent to the area that's affected by the civil authority order, by the military order. In California, I would think that if I had a client who had 5 miles, his policy said that if he was within 5 miles of an order of civil authority that brought access to a certain part of Santa Barbara, he was covered, even though he was not directly affected by the order. I would think that 5-mile limitation will be out the window today in California, where you have statewide order. It would seem to me that would eliminate any reliance by the insurance company on a distance restriction or any kind of requirement that you be close to the area affected by the order of civil authority. The ISO exclusion, I've seen versions of that exclusion that say New York virus exclusion. What does that mean? If it says New York virus exclusion, I would think the average, normal, reasonable policyholder would think, okay, maybe I don't have coverage in New York, but I have coverage everyplace else. And we actually have that in a policy where an insurance company has agreed that the exclusion that says New York virus exclusion only applies to New York and no place else.
Julie, looks like you want to contribute something. Please go ahead.
Well, I think it's important to underscore where Leena began, which is that an exclusion does not apply, and we don't even get there unless there's coverage in the first instance. So at first, coverage needs to be established under the insuring agreement. This situation is very analogous to what we encountered post cyber hacking in 2011 when Sony was hacked, the Sony PlayStation case. In that era of time, there was no such thing as a cyber exclusion. And although Sony had a cyber policy that was specific to covering this type of loss, it was for low limits and based on the amount of people affected, would not have covered the loss or resolution of overall exposure for that claim. So Sony looked to its commercial general liability tower and attempted to establish coverage there. And there was great debate about whether the commercial general liability policies covered such acts as hacking. The CGL has 4 triggers: bodily injury, property damage, neither of which were triggered, but it has a personal and advertising injury trigger. And this was regarded by Sony and the policyholder firms as an invasion of privacy for which there was no exclusion. There was no exclusion for cyber for a very good reason. There was never any coverage for cyber under a CGL policy ever contemplated. So I think we find ourselves in a similar situation here. There are a number of reasons also in the process of underwriting in which you would find that there are not exclusions added to a policy. There are some accounts for which it would be easy to get that exclusion on, and some accounts not so much, or the risks inherent, or the parties agree to disagree. If in fact the application of the exclusion was discussed, I think that would be interesting to note if that in the course of any litigation. But many carriers may have avoided putting the exclusion on because they did not anticipate that coverage would be triggered in the first instance.
Jeff, if I may comment on that?
Please, Jerry.
You've opened up a whole new area for us to think about. The cyber liability cases. I've done seminars just devoted to that one issue. There's a body of case law that goes both ways on whether or not computer losses, loss of data constitutes loss of property that will be covered by a general liability policy or not. And the issue there is very interesting because it's relevant here as well. General liability policies typically define property damage as physical injury to tangible property. So when the insurance companies say they need an alteration in order for the business property insurance to apply, my answer to that is they're really looking for tangible injury, which is not what the policy says. That's what the liability policies say. And there are cases that go both ways on whether or not computer losses were covered by general liability policies or not. It finally got to the point where the insurance industry just wrote a flat-out exclusion. So we're not covering cyber liability cases under general liability policies. But before they did that, there were cases on both sides as to whether or not loss of data, loss of access to your computer, whether or not that can constitute physical injury to tangible property. And those cases are instructive today because they do go both ways. But there are helpful cases in that history which are relevant to what we're dealing with here today.
Jan Larson, the next topic is yours to lead for the lead, and that is the topic of legislation, proposed legislation, both on the state level and the federal level. Why don't you please put the ball in play on that topic, and we'll ask Julie to comment first on that.
Wonderful, thanks, Jeff. I'm going to first talk about legislation happening at the state level and then give Julie an opportunity to comment on that, and then we'll turn over to what is happening at the federal level. So since mid-March, there have been numerous bills proposed in at least 8 different states, some states having multiple bills. Those states include Louisiana, Massachusetts, Michigan, New Jersey, New York, Ohio, South Carolina, and the District of Columbia. By and large, the legislation that has been proposed looks to require insurers to provide coverage for interruption losses as a result of the pandemic. And that's true even where there are provisions in place in those policies that could be argued to exclude coverage. So far, none of the legislation has been adopted by any of the states that I mentioned earlier, and it has been subject to significant insurance industry opposition that I think Julie will touch on in just a moment when she has an opportunity to comment. There are a few key features of the proposed legislation at the state level that I think policyholders in particular should be aware of. They break down into basically three categories. So first, there is coverage under some proposed bills, but it would be retroactive. So in about half of the bills, they are drafted such that if they are passed, they would apply retroactively to early March 2020 when the pandemic started, while the other half are drafted to apply only to policies that would be in effect on the date that the proposed bill eventually becomes effective. So that's an important first distinction. Second, the application of the proposed legislation often depends on the size of the business. The majority of the proposed bills are drafted such that they would only apply to businesses that are quote unquote small businesses. And that typically means that you have fewer than a specified number of eligible employees within a particular state. Most of the bills that are out there have 250 or fewer eligible employees. The number can differ a little bit, but it's typically not higher than 250. There are two notable exceptions to that, where states have taken a slightly different approach. New York is one exception. They have a State Bill 1114 that would apply to any business seeking coverage, and you would basically get 100% of the loss for small businesses and 75% of the loss for a non-small business. The distinction between small and non-small being set by the US Small Business Administration's criteria. The other exception that's worth mentioning is Louisiana. They have a State Bill 477 that isn't making any distinction at all between sizes of businesses. They're just saying that businesses are covered without regard to the number of employees that they have. And then the third point that I want to mention quickly before turning it over to Julie is that some of the proposed bills do in fact provide insurers with some form of relief for the payments that the insurers would make under their policies. So what that would look like in practice is that the insurers would pay the claims under the existing policies, and then those insurers would apply to a state entity for reimbursement for those payments. The reimbursements rather, would be funded by newly formed assessments that the insurers would have to pay going forward for operations within that particular state. And then by comparison, the remainder of the bills that are out there at the state levels really don't provide any form of relief or reimbursement to the insurers.
Julie, from the standpoint of the insurance carriers, the insurance industry, please.
Thank you. So with respect to the state litigation, it's problematic in two respects. The first is that they're generally limited in scope to small business. So it is not a universal solution for all businesses. Naturally, the larger businesses will probably have more political influence, and it is, generally palatable to create a solution for small business with which no one can argue. However, it is not universal, and so it really isn't an all-encompassing problem solver. The second issue is the retroactive application, and that's problematic for two reasons. The first is that it fails to understand that the business of insurance model is that many will pay premium for the few instances of claims that are expected to incept. The models with respect to property damage and data supports a certain premium level and a certain risk appetite that is not contemplated by the current pandemic risk, nor has any premium been collected for that. In a Wall Street Journal opinion on April 21st, the CEO of Chubb, Evan Greenberg, pointed out that there is $800 billion in surplus in the insurance industry. This is for all risks, all lines of business: property, casualty, E&O, D&O, and thus it is completely imaginable that that little amount, that money can actually reimburse for all of the losses that have taken place. He also estimates in that opinion that that solely small business losses since the inception of the pandemic total 250 billion to 430 billion. Therefore, the entire insurance surplus would be diminished in less than 2 months if retroactive application without any premium collection were adopted as a resolution to this. Secondly, retroactive application is, and this is the lesser of the arguments, I think, because it takes longer to get there, but it's unconstitutional. I mean, I think that litigation with regard to coverage will go on for some time, but on average, it takes 10 years to get to the Supreme Court. So we really don't have that kind of time. However, it really does fly in the face of the constitutional right of contract. And therefore, I view that these state efforts that include retroactive application as political theater and not a real solution.
Thanks, Julie. Jan, any brief comments on that, or shall we turn to the proposed federal legislation?
Let's turn over to the proposed federal legislation, sticking with the theme of political theater, which is almost always at play when you're talking about the federal government. So at the federal level, we have two different pieces of legislation that are that have been introduced at this point that I want to touch on briefly and give Julie an opportunity to comment on. And then there's also a separate thought piece that some groups within the insurance industry, trade associations, have proposed that they would like the federal government to take up in addition to the existing two pieces of legislation that are out there. So first, the earlier of the two pieces of federal legislation from April 14th is what is called the Business Interruption Insurance Coverage Act, BICA. This is something that is still pending, but it is very similar to what a lot of the states are trying to accomplish, in that it seeks to require the insurers to cover business interruption losses that are the result of viral pandemics such as coronavirus. And that would be without regard to any exclusionary language that might be contained in the policies. Notably, BICA is different from what the states are proposing, or at least what many of the states are proposing, in the sense that it does not have a provision in it currently that would provide a mechanism for the federal government to reimburse insurers for those payments. There is a provision, however, that appears to allow insurers to basically reinstate exclusions that were already in policies as of the date that BICA might eventually be enacted. And it would allow insurers to do so after providing the policyholder with 30 days notice that there would be a premium increase required in order to prevent the reinstatement of that exclusion. So they're at least offering something to insurers there, but not much by way of reimbursement. So then more recently, yesterday, there was a second bill introduced that is the Pandemic Risk Insurance Act of 2020. PRIA is the acronym there. So PRIA is modeled after the Terrorism Risk Insurance Act, TRIA, which came into being after the 9/11 terrorist attacks. And PRIA would operate in a similar manner, in that it would create a go-forward reinsurance program and backstop for insurers who, going forward, offer business interruption coverage that would explicitly include losses due to viral pandemics such as the coronavirus. And they would also require that there be a federal emergency declaration involved in order to trigger that coverage. And all of that would take place only after January 1st of 2021, according to the current legislation. A couple of notable things about the PRIA legislation is that it would be voluntary for insurers to participate in. However, if they choose to participate, they would then be required to offer that type of inclusive coverage as part of their policies. And then one other notable aspect of the mechanics of PRIA it would basically provide that the participating insurers would be responsible for covering the first $250 million of losses incurred by policyholders. Once that threshold is reached, the federal fund administered by the Treasury Department would kick in and cover 95% of the additional losses up to $750 billion total in any single year. And then the remaining 5% would be spread among the insurers who are participating. So let me take a pause there and turn it over to Julie to comment on those pieces of legislation.
Thanks, Jan. Julie, please.
So the positive on BICA is that it does contain a premium collection component. It's questionable whether it would apply retroactively or prospectively, but at least it acknowledges that carriers cannot pay for this risk without some mechanism for collecting premium. But it is true that does not include specifics as to a federal backstop, which is the case in the PREA statute as proposed. So it seems that there are two potential avenues. First, we have the current situation, and then we have what are we going to do going forward, right? Certain trade organizations, such as the National Association of Mutual Insurance Companies and the American Property Casualty Insurance Association, have proposed their own solution modeled after federal flood insurance rather than as an alternative to these two proposed bills to sort of push the responsibility for a solution out of the realm of the insurance industry responsibility. However, the bills do have support from the National Retail Federation, and importantly, Marsh & McLennan, a major insurance broker who is clearly interested in divining a solution for its represented clients and policyholders nationwide. TRIA has been lauded as an absolute win of public and private partnership. In the wake of 9/11, we needed to come up with a solution to the uninsurable, incalculable risk of terrorism. And this pandemic situation, though a little bit more complex because it doesn't have the same constraints or limitations of geography that a typical terrorist incident does, is viewed as doable. However, we will need to account for some mechanism to collect premium for the risk across the broadest possible participation of policyholders, and then a backstop, which it is assessed is best conceived along with the participation of the federal government rather than the states for obvious reasons. Uniformity is most likely a driver that is preferable to a state-by-state solution, given the complexity and broad-based risk involved.
And Jeff,
Yes, Jan.
I'll just add
Please.
one theme to pick up on what Julie said is the business continuity protection program that has been proposed by the insurance industry trade associations, separate and apart from the two pieces of federal legislation that we were discussing, is quite different by comparison and is effectively what amounts to a self-insurance program where private and public companies would purchase revenue replacement coverage that would then come back to them in the event of a pandemic like the one we're in now. So my only comment on that alternative piece of proposed legislation that is out there and that may eventually get to the federal government level would be, I'm simply not convinced yet that sort of self-insurance route is the correct one for what we're facing here.
Fair enough. Well, our hour is up. I want to thank everyone for this really sophisticated, in-depth, advanced, high-level discussion of these important issues. There are 3 points I want to make before we close. The way we always close an insurance law program, really the way we open them as well, read the policy. Read the policy, because the specific language of your insurance policy can make all the difference and probably will make all the difference in terms of how the particular case comes out. Number 2, this program has been part of the Will Work for Food project, hashtag Will Work for Food. So we encourage everyone to contribute either to one of the 5 food banks we mentioned at the beginning of the program or to another food bank of your choice. Third and finally, I want to thank these 4 wonderful, outstanding panelists, true experts in alphabetical order: Jan Larson, Jerry Oshinsky, Leena Soni, Julie Weerth, all just wonderful speakers and really knowledgeable experts. Thank you all very much. Thank you all for watching the program.
Stay healthy, stay upbeat, stay in touch.